In the meantime, the minutes of the Fed's last meeting will be released this afternoon. Many will look for clues about the next rate hike, but there is something else that investors should focus on as well. Steve Leisman joins us right now. He's got more on that. Steve, let's talk about this, and then maybe at the end you could comment on Jamie Dimon's thoughts on that Paul Volcker moment.
Yes.
And what we should be watching.
Yeah, Becky, the big debate in Fed policy right now is whether the Fed tapers bond purchases this year or next. And does it raise rates late in 2022 or 2023? But that debate obscures a profound change in the outlook, which is underpinning the stock market. And that's just how patient Fed Chair Powell has convinced markets the Fed is going to be. That the debate over whether the next rate hike is 18 or 24 months away, hard to get excited about, but it shows a measure of success by Powell that Fed Chairs Bernanke and Yellen did not enjoy. The spread between the Fed funds and the two-year note, showing where the Fed is now versus where the market thinks it's going. That ranged from 25 to 60 basis points during much of 2011 and 2015, a sign the market was always anticipating rate hikes. The spread right now, it's at the highest level of the year, but it's just 10 basis points. The two-year, it's remained tame, now just 16 basis points, even after passage of President Biden's big relief bill and that blowout jobs report that we got on Friday. Lou Crandall, he follows every move by the Fed from Wrights and ICAP. He tells me the fact that we think the big issue is whether the first rate hike is 2 years or 3 years away is a sign of how extraordinarily successful the Fed has been at convincing the markets that they will be highly patient. What are the policy changes Powell's enacted? He's ended preemption, the idea of raising rates before inflation actually happens, aiming for inflation above 2%, focusing on employment shortfalls and including minority unemployment gaps in his calculation of how far or when to hike rates. Paul McCulley tells me the death of the doctrine of preemption is the bedrock on which the current stability on the outlook is based. None of this says Powell's policy is right, that he should stay easy, only that he's convinced markets to an extraordinary degree that he means business, Becky.
And yet, Steve, we hear from Jamie Dimon this morning that he thinks inflation may be stronger than the traditional measures that we rely on, the things that we watch, and that he's concerned that if inflation does start picking up, you could see, Andrew just described it again, this moment where overnight Paul Volcker raised rates by 200 basis points and what that meant for the economy afterwards, the crash in the economy that came with it. So there are certainly those who have been around for a long time who are watching this and wondering if there's going to be a moment that hits.
I think that's right. And I think Jamie has correctly identified one of the big risks out there for the market, and that is that the inflation that, by the way, the Fed and everybody expects ends up not being temporary. I will say when I look at the two-year note, which is 16 basis points, it popped up to 18 on Friday, which is like, big deal, I guess. And the 10-year note now at 162, it's hard to see a lot of inflation built in. I guess I'd also challenge Jamie, which he's always up for a good challenge, to show a metric that does a better job at telling me where inflation is in the economy. I keep looking for it. There are multiple inflation metrics out there. Most of them remain pretty tame, although they're going to pop up for basis points reasons or base reasons and others for the next several months. But the idea that we have some sort of incipient inflation under the radar that we're not picking up, I guess I'd challenge that.
Shepard Smith here. Thanks for watching CNBC on YouTube.